Good day, ladies and gentlemen. This is another recording on accounting, basic accounting, on the topic of subsidiary journals. On the topic of subsidiary journals. I have a question that was out of 40 marks that I will use for this recording. It read as follows. For each of the following transactions, indicate in the table from the following. The table must be as given below. You have a column for the number, column for the source document. It further says indicate whether the source document is original or a duplicate where applicable. If there's a need for us to say original, we must indicate, or duplicate, we must indicate if it's necessary. Then the next column is the book of prime entry, or books of prime entry, which is your subsidiary journal. In your book of prime entry, we know that we are recording either cash receipt journal, or a cash payment journal, or debtors journal, or as debtors allowance journal, or creditors journal, or creditors allowance journal. The last one is your general journal. So this is the list that will be recorded, or one that will be recorded under the book of prime entry. It's likely to be one of them, either cash receipt or cash payment, or debtors journal, or creditors journal, or allowance journal. The next one is the account debited, and the last one is the account credited. Then we will read each of the transactions that are provided to us, 11 of them. I, however, added this other question. It was not based on this question in the year of this assessment, but I added it from the following question. Question 2 of this question paper was based on the capital contribution. I just decided to move and apply the principles where capital is contributed, and how do we record that in the subsidiary journals. But it's also quite important for understanding and note that capital contribution can also be an item that gets to be recorded in the subsidiary journal, and also your consumable items, or something that is taken by the owner for personal use. But I wanted to bring the capital contribution. Now we have transaction number 1 up until transaction number 11. That must be recorded in the books of prime entry. Then I will open a separate document where then I will be doing the workings. Then we'll have our number 1, or our number, where we specify if this is number 1 or number 2 or number 3. Then after, we will have a source document. We'll have source document. Remember, under source document, we need to specify if is it original or is it a duplicate, or where necessarily. Then after, we have book of prime entry. Book of prime entry will specify if is it a cash receipt, a cash payment, debtors journal. Book of prime entry, or is it creditors allowance journal, or debtors allowance journal. Then after, we have account debited. We have account debited. Then the last one will be account credited. Then after, we have account that is credited. This partly incorporates your ledger accounts, or incorporate the principle of debit and the principle of credit, which is also in the ledger accounts and which is also in the general journal. But now we are doing it from the perspective of the books of prime entry. but incorporating the concept of debit and the concept of credit. So we are doing almost two things at the same time with the approach that we have used in this question. Now, this is how your workings ought to look like if you were to be required to record transaction in this table format with the main focus on the subsidiary journal, but in the table format that is given to us. Now I will read the first transaction, try to analyze, then after record accordingly. It says services rendered for 1,000 Rand cash. The minute the services that are rendered or anything that we have done is of a cash, we already know that under the books or the book of prime entry, we also have what is called cash receipt journal. If we received money, that will affect our cash receipt journal. So this will be our cash receipt journal in terms of the book of prime entry because this is cash. But if we look at the second one, this is on credit. Therefore, now we need to check if did we buy on credit or did we sell on credit. If we are buying on credit, that will be creditors journal. If we are selling on credit, that will be debtors journal. So let me stop there. We'll still do our number 2. Now we are very clear that number 1 is cash. So cash receipt journal will be affected. Then let's ask ourselves, what did we do? We rendered services rendered. And we know that services rendered is income. And incomes increase on the credit side all the time. Incomes increase on the credit side. And income is an income. So that means we already know that income will be increasing here, which is services rendered income, will be increasing on the credit side. That means the account to be credited will be services rendered income, or you can say services rendered income. Now, services rendered will be increasing. Why will it be increasing? Is because we received cash of 1,000 Rand. So if we receive cash, we expect that our bank account must increase. I could have started also with that because this is cash. So our bank will be affected. That means the account to be debited will be bank. Why? Because we received money for the services that were rendered. Then after, we will have on the credit side services rendered as the account to be credited. And once again, whenever cash is affected, our bank will be affected. In this case, because we have rendered the service, that means if we are a hair salon, we render the service of whatever hair it is to our client, and the client gave us 1,000 Rand. If we are a painting company, our services is to paint. Therefore, now that will mean we painted for the client and we received money. That is why now cash will be affected as a plus in our bank account. Remember, bank is an asset, and assets increase on the debit side. Whenever we receive more money, bank will be affected on the debit side, which is the left-hand side in the T account. And also, please note that we don't write the plus or minus in these transactions, but we just record in the relevant side. Then, because cash was involved, so that means in here there is likely to be a cash register role because we are selling to a customer. So this will be a cash register role. Cash register role, it will be one of the source document, or a duplicate receipt because we need to produce a receipt to a customer. A duplicate receipt. If we are not a customer, if we are a company and not a customer, therefore it becomes a duplicate. The only time it will be original is when we are a customer. The customer always takes the original document and the company always takes the duplicate. The customer always takes the original, and we are left with the duplicate. And in this case, we rendered a service to a customer. So we are going to give a customer the original document, so that if the customer wants to return, if we are selling a product, then the customer can bring the original document. So us as a company, when we are acting as a company, then we will be taking the duplicate. But if we are buying from a supplier, that means we are a customer to a person who is supplying us. Then in that case, we are going to have the original document, which will be original invoice when we buy. But when we sell, we will have a duplicate receipt in the case of a receipt. So now under our number 1, we have clarified that 2 accounts are affected. The first account that is affected is services rendered. The second account that is affected is cash, which is our bank. And we said bank is on the debit side and services rendered is on the credit side. Now let us then do our recording. Number 1, we said this will be duplicate receipt. It can be one of them or a cash register roll. Let me just use duplicate receipt. Sorry, this color does not look bright. We have duplicate receipt under our number 1. We have duplicate receipt. That means we will be left with the duplicate on our side. We are recording in our books. The customer will get the original document, then they will record on their side if they need to record. Then we said we received money from a customer for services that were rendered. So this will be cash receipt journal. Account debited, we said money in the bank will increase. Why? Because we received money for the services that were rendered. And we said the entry to be credited will be services rendered income. If you want to take it further, you can say services rendered income. But we know that services rendered, it is an income. So this is how you'll be recording a transaction where a service was rendered for cash. It does not matter what type of service it is. If it's a service that we render and is for cash, this is how this is likely or ought to be recorded. Then after we go to the second transaction, do the analysis, then after we record again. Services rendered. If we render services will always increase on the credit side. If we render services will always increase on the credit side. So that means also on this one, services rendered income will be recorded on the credit side. Similarly, with the first one that we just recorded, services rendered was recorded on the credit side. Why? Because income increase on the credit side. So just hold that one. All other details as we progress will explain the full reason why it's always on the credit side. It will never be, it's not on the debit side. Then after we then now have to say, how did we render this service? Did we receive money? The answer is no. But we know that the minute we render services, then they will increase on the credit side. The question is, how did we render this service on credit? Remember, when we are rendering service, it's like we are providing our service to a customer, or we are selling a service to a customer. Then because we are selling a service to a customer and the customer did not pay us, the minute we sell something to a customer or we render services to a customer and the customer does not pay us, that is called on credit, or sometimes the term called on account. Therefore now, if we are rendering a service to a customer or we sell a product to a customer on credit, that means the customer does not pay us. Therefore now, the customer who has not paid us is called as a debtor. So now that means the account that will be increasing on the debit side will be a debtor. Remember, a debtor is an asset, and assets increase on the debit side. So that means The more we sell something to a customer and the customer does not pay us, the more the customer's account, meaning the account of the customer, will be increasing because the customer is not paying us. We render a service of 3,000. That means the account of the person who owes us, who is a customer, called debtors or accounts receivables, different terminologies, or debtors control, whichever you use, will be increasing on the debit side. But remember, we don't write the plus, we just write it on the debit side. So because this is a debtor, then it will go to what you call debtors journal. A debtor, remember, is a customer who have not yet paid their account for the services you rendered or for a product you sold to them. Then after we then now need to come to our source document. Source document will be again duplicate invoice. We use invoice when we sell on credit. Duplicate invoice. Whenever we sell on credit or we sell for cash, is always duplicate. That means the document we keep on our side is a duplicate, and we are recording on our books based on our documents. So we keep the copy, which is the duplicate. The customer will get the original. So we as a company, we always keep the duplicate. But when we are a customer, meaning when we are buying from the supplier, we are therefore now a customer from our supplier, then it will be an original invoice. I think I did mention that also in the previous question. Then now let us go and we record in our table that we have done. Date number 2, we say this will be duplicate invoice. We use the word invoice when we render a service on credit or when we sell a product to a customer on credit. And we said the customer whom we rendered a service did not pay us. Therefore, that is a debtor. Then it goes to the debtors journal, meaning the journal of the people who are owing us, called debtors. They have a journal called debtors journal. Account to be debited, we said it will be debtors, meaning people who are owing us money, they are increasing, and they increase on the debit side because a debtor is a customer. Remember, once again, this can be called account payables. Account receivables. Account receivables. That will also be another terminology. Any of the two is correct. Or debtors control. Debtors control or account receivables. Account to be credited, we said that will be services rendered. Services rendered. That will be our number 2. 9 transactions, 9 now are left. Then we go to the next transaction, which is transaction number 3. Transaction number 3. Transaction number 3 says pay the advertising. Pay. If we pay, that means bank is affected. And obviously, if we are paying, we are expecting that our cash, which is our bank account, must decrease. So obviously, if we are paying and we are saying to pay, it means it's a bank account, meaning our account bank will be affected. If we pay, bank is affected. And again, if it's cash, I mentioned that bank is affected. If we pay, bank is affected. Sometimes we use the term called EFT. EFT. So if you see the word EFT, that means money went out via electronic fund transfer. So sometimes you might say EFT for advertising 300 Rand. So that means money was paid via electronic fund transfer. So that will still be our bank. So if you see EFT, that is still bank. Then you need to check if is this EFT because money was coming into the business, or is this EFT meaning that money was going out of the business? Then you just need to check those two. In this case, this EFT or payment indicating money that is going out to advertise our product or to advertise our business or to advertise our service. So that means our bank will decrease. We know that bank decrease on the credit side. So that means our bank will be recorded on the credit side, meaning account to be credited. Which other account is affected here? What did we pay for? We paid for advertising. We paid for advertising. If you are doing practical accounting, you will know that advertising on page 19 is an expense, and expense increases on the debit side. So expenses increases on the debit side, and once again, expense will always be increasing on the increasing side, if I were to say so. Meaning if expense increase on the debit side, you'll always be recording it on the debit side. Similarly with your income, if your income is increasing on the credit side, you'll always be recording it on the credit side. It's only as we go to the advanced level that there will be recording on the other side. So advertising, we know that is an expense, and expenses increase on the debit side. So that means the account to be debited will be advertising, and the account to be credited will be bank. Bank is decreasing because money went out of the business because of the payment of advertising. Account to be, book of prime entry, sorry to take this one backwards. Book of prime entry, obviously there is a payment here, EFT or pay or payment. So if we pay, that means we know that the journal that will be affected will be cash payment journal. Cash payment journal is a journal where we are recording money that went out of the business. Then after, in terms of the source document, as I've already mentioned, that the source document can be EFT. When we are making a payment, we can use EFT or original receipt Remember now, in this case, we are paying someone else, so we are the one that ought to keep the original receipt. So this can be original receipt. If maybe we deposit money to pay for advertising, maybe in the bank account of this advertising company, we are going to keep the original document, and they keep the copy or duplicate. Then that will be our number 3 that we are dealing with. Then we record now our number 3 on the table, which in the analysis we have already done. So we say source document will be EFT. We can just keep one of them, EFT. And we said money went out. This will be a cash payment journal because money was paid for advertising. We said account to be debited will be advertising because we have paid for advertising. And account to be credited, we said it will be bank. Why? Because money went out of the business to pay for advertising expense. So we are very clear that bank is affected. Most, or if not all the times, transactions will be clear, but you need to know how to analyze which accounts that are affected on a transaction that you see. Now the next one is our transaction number 4. Transaction number 4, we are done with number 1, number 2, and number 3. Transaction number 4, received 2,500 from a debtor. Most of the time, if we receive, we are receiving cash. But you might need to know, just check if they say receive. But a number of times when it says receive or received, we can say received or received 2,500 from a debtor. That means obviously if we are receiving something from a debtor, it must be in the form of cash. Remember, a debtor is the person whom we rendered service on credit. This is the debtor. I mentioned this one before. A debtor is a person who is owing us money for something we gave to them, but they did not pay us, which is our account receivables. So now this customer whom we rendered services for 3,000 rands, and the customer did not pay us. Now this customer is paying us 2,500 rand. So we have received money. Then if we received money, obviously it has to be plus in our bank account. Our bank account must increase. Then the question is to say, what type of account is bank? Bank is an asset. Which side does bank account increase when we receive money? Bank account increases on the debit side. So account to be debited will be bank. We have received money from who or for what? We have received the money from a debtor. A debtor has paid their account. So if a debtor is paying their account now, that means the account of the customer must decrease. The account of the customer must decrease, and the account of the customer called debtors control decreases on the credit side. If you remember previously, when we rendered the service to a customer where we said debtors control, we recorded it on the debit side. Why? Because the account of the customer called debtors control or account receivable increases on the debit side. But when the customer pays us, then their account must be decreasing on the credit side. That is why we have debtors control recorded on the credit side in this case. Why? Because the customer is paid us, therefore now their account must decrease on the credit side. The amount will be 2,500 rand. But the amount is not our main concern or main focus. If there was a column that says amount here, then the amount to be recorded was going to be 2,500. But the main focus in here most of the time, or in terms of the marks also, is the account debited, account credited, book of prime entry, and the source document. Now let us go and record our number 4 now in our table. Then our number 4 on the table, we say we have received money. Obviously, if we received money, that will be EFT. If we received money, that will be EFT. Then we have our EFT. If not all the time, most of the time, whenever cash is involved, EFT is just involved. Just know, if there is cash involved, EFT is just likely to be one of the source documents affected. Because these days we no longer have checks. So if there is cash involved, know that EFT is a default alternative that you must just use. This is our number 4. Or else it can be another what you call bank statement. It can also be a bank statement, because the customer can pay straight to our bank account and we see it in the bank statement as evidence that customer so and so has paid their account, and we are seeing the reference in the bank statement. So we can have EFT, or we can have the bank statement, or duplicate receipt, where the customer will keep the original and we get the duplicate receipt. But only one you are likely to get marks for it. So now in this case, we received money from a customer. So this will be a cash receipt journal. And we said account to be debited will be bank. We received money. And the account to be credited will be our debtors control, or account receivables. Whichever one you use, they are all correct, or account receivables. So this will be our number 4. Only 7 of the transactions are left before we finish. Number 5 says buy consumables on credit. What did we buy? We bought consumables. I always say whatever you buy, you always have more of it. And whatever you buy and you have more of it, it will always increase on the debit side. Whatever you buy, there's nothing that I remember that you can buy and it will be recorded on the credit side. I'm referring now to the something that you buy. The other entry on the credit side is another story. If you are buying machinery will be recorded on the debit side. If you are buying equipment will be recorded on the debit side. If you are buying vehicles will be recorded on the debit side. If you are buying land and building land and building will be recorded on the debit side. So let me just say, whatsoever that you buy, it will always be debited. So that means consumables will be debited. They will be increasing on the debit side. Then the next question will be, how did we buy? Did we buy for cash? If we buy for cash, bank will be affected. If we buy for cash, bank will decrease on the credit side. So we'll record bank. Remember, we know that bank is decreasing on the credit side. But the question is, how did we buy in this case? We bought on credit. We bought on credit. Previously, services were rendered on credit, meaning we sold, in other terms, we sold our services to a client on credit. So the second transaction was a sale, where we render a service or we sold our service. We normally don't say sold service, we normally say render service. Like if you are buying and selling electricity is not a product, it's a service. So it's the same as saying selling electricity. So whenever we sell on credit, a debtor is affected. But if we are buying on credit, a creditor will be affected. A creditor will be affected, which we can say creditors control or accounts payables. Account payables. Account payables is a liability. This one is equal to liability. Liabilities, we know that liabilities increases on the credit side. Again, refer to page 19. You'll see that account payables is under liabilities, which is under your current liabilities. That means short-term liabilities. So now, meaning the account that will be credited will be creditors control or accounts payables. In other words, we are saying we are increasing our liabilities whenever we are buying more on credit. That means we have more liability to pay. Obviously, if you buy on credit, you expect that the people you are owing them to be increasing. So that's exactly the same case. But don't forget that whatever you buy will increase on the debit side. Then if we buy on credit, we have a journal where we record. If we buy on credit, we record under the creditors journal or purchases journal. Whenever we buy on credit, we record under purchases journal or creditors journal. But whenever we sell on credit, we record under debtors journal. Or if we render a service on credit, that will affect our debtors journal as we did under our number 2. Then when we come now to our source document, it will be original invoice, because now when we are buying from a supplier, we are a customer from our supplier. Whoever you are buying from, you are a customer. So as I mentioned before, that a customer always gets the original document. A customer always gets an original document. And in this case, we are a customer. We are getting the original document. But when we render a service to a customer, like in your number 1 and number 2, when we render a service to a customer, we are giving the original document to a customer, but we are left with the duplicate, and we record from the document that remains in our business. If it's the duplicate that we are left with, we are going to record using the duplicate document. But in this number 5, it will be original invoice, because we are the customer. Original invoice. That will be our original invoice, because we are going to get the original document from our supplier, because we are a customer to them. So they will give us an original, but they will be left with the duplicate invoice on their side and record using the duplicate invoice. So now let us go to our recording of number 5. Number 5, we said we have original invoice. Original invoice. Whenever the transaction is on credit, we are using invoice. Remember previously, when we render a service to a customer on credit, we use the term invoice because the transaction was on credit. Please make sure that you don't make a small mistake. At least make sure that you are always in the right terminology. When it's on credit, the invoice is affected. But because this was to a customer, we render a service to a customer, so it became duplicate invoice. But in this case, we are buying from the supplier, but we are buying on credit. Because we are buying on credit, then the name of the document will be invoice. But the question, is it original or a copy? In this case, it will be original because we are a customer from our supplier. So that will be the source document. This will be our creditors journal or our purchases journal. Whenever we buy something on credit, we record it under our creditors journal. Then account to be debited, I mentioned that whatever you buy will always increase on the debit side. We said in our transaction we bought consumables. So if we buy consumables must increase on the debit side. And they were bought on credit, therefore now the account to be credited will be creditors control or account payables. Creditors control or account payables. Then we go to transaction number 6. Transaction number 6 now is a return of goods. As I can see it, we are sending goods back to our supplier. A return of goods. It says send damaged consumables back to Doji Dock to the value of 60 Rand. Remember previously we bought consumables on credit. How much? 1.5. From who? From Doji Dock. So now in this case we are returning some of the goods. And we use the term send damaged consumables back to our supplier, which is Doji Dock. Or else we can say returned goods. In this case, we say send damaged goods back. Or we can use the term returned goods. Or we can use another bit more technical term that says received a credit note. Received a credit note. Sometimes we can use this terminology. Received a credit note. When do we receive a credit note? We receive a credit note when we return goods to a supplier. Then the supplier will give us a document that says, I acknowledge the receipt of, I acknowledge the return of your goods. So a credit note is a document that is acknowledging the return of the goods by the supplier. So if the terminology says received a credit note, then you must know that is the return of goods back to the supplier. Is the return of goods back to the supplier. So that is the same terminology. Please be familiar with the terminology that I'm also adding in this question. So now we are returning. What are we returning? The consumables we bought before under transaction number 1. So when we buy, remember, consumables increase on the debit side. If we return, we expect them to decrease because you are reducing them from the business or from the storage. We are giving them back to the supplier. Previously, we said we increase our consumables, then we recorded our creditors control. Therefore, now this will be the opposite of what we did. Previously, when we bought, it was consumables on this side and creditors control on this side. Now that there's a return, this will go to this side, recorded on this side, and this will be recorded on this side. It is the reverse of what you did before. Whenever you return, is a reverse or inverse of what you did. So there will be less of our consumables and there will also be less of our creditors because we returned. We expect that how much we are owing our creditors to be decreasing by the value of goods that we have returned. And in terms of the journal, this is called creditors allowance journal. So now let us go and do the final analysis of our number 5 or our number 6. So now we know that our consumables, as I mentioned, they will go on the credit side. We have our consumables on the credit side. Then now, obviously on the debit side, we need to have our creditors control. Creditors control. Book of prime entry, remember this is a return. A return will be under our creditors allowance journal or purchases allowance journal. That is where we record our returns. Source document under number 6 will be our original credit note. It will be our original credit note. Remember I said that they can say received a credit note. So that credit note is a source document acknowledging that we have returned goods and the supplier accepted our return. So that will be original credit note. Therefore now we go there, we have our original credit note as our source document. This is creditors allowance journal. It is where we are recording goods returned back to the supplier. It is creditors allowance journal or purchases allowance journal is one and the same thing. But you can just use the word creditors allowance journal, which is CAJ. Then we said we'll have our creditors control here. Creditors control or accounts payables. Then our consumables must decrease on the credit side because we have returned our consumables back to our supplier and the amount of our return was provided to us as 60 rand. Was provided to us as 60 rand. So our creditors will decrease if we return or if we pay them back. Then number 7, pay. And once again, the minute you see the word pay, we had the same similar word there, pay. If you pay, you know that your bank is affected. It's either they use the term EFT. I'm just reading over now, scanning the transaction. There is EFT. EFT and pay. We know that bank is affected and our bank is decreasing. So that means we will have our bank as our account to be credited because bank decreases on the credit side. Then after, what did we pay? We paid for wages. Wages is an expense, we know that, but we say wages expense. Expenses increase on which side? That means your wages will be increasing on the debit side. So debit side, we have our wages. On the credit side, we have our bank. Then did we receive money or did we pay money here? We paid money. So if we paid money, that means this will be cash payment journal. Cash payment journal. We paid for cash. So that will go to the journal where cash is paid, called cash payment journal, CPJ. Source document, that will be obviously if we are paying, that will be EFT. We paid, as I mentioned to you, if there's a payment, either money is coming into the business or money is going out of the business, just write EFT because it's very likely that it will be EFT because we no longer use checks. Then that is under our number 1. Then we record our number 7 once again after the analysis. We have EFT as our source document. We said money was paid, so this will be recorded in the cash payment journal. Then we said, what did we pay for? We paid for wages. We paid for wages. So wages is an expense. Expense increases on which side? On the debit side. Money went out of the business Because money went out of the business, then bank must decrease. Remember, bank is an asset, and bank as an asset is decreasing now on the credit side because money went out of the organization to pay for wages. So if you start with this one, which is always clear, whenever money goes out, bank is decreasing on the credit side. The minute you record that, you know that the other account will be on the debit side. And in this case, it happens to be an expense of wages, and wages are increasing on the debit side all the time. Then we go to transaction number 8. Transaction number 8. Then our transaction number 8 read as follows. It says pay. Once again, the word pay is appearing again. There is the word pay under number 8, which also appeared under our number 3, which was also in the same context as our EFT, which was also in the same context as our cash. We can say that bank is affected. And these are the terminologies that can be used to indicate that bank is affected. Now we need to ask ourselves, is money going out here or money coming into the business? If it says pay, money is going out. When money goes out, bank decreases on the credit side all the time, not sometimes. Whenever money goes out of the organization or of the company, bank is decreasing on the credit side. What did we pay? We paid rent. That means this other account will be on the debit side, rent. In this case, rent is an expense. Rent is an expense. So expenses increase on the debit side, and there we recorded our rent expense. The amount is 7,000, but in this case, we don't have the column for the amount. Once again, pay is money going out, which is cash payment journal. So that will be under our book of prime entry, CPJ. Money went out, cash was paid. So it must go to the cash payment journal. Source document. Obviously, if money is affected, I mentioned that make no mistake, EFT must be your mistake. If money went out or money came in, EFT must be your mistake. Make a mistake writing EFT if there was money paid or money that went out of the organization. Or else that can be an original receipt. Original receipt. Then that will be under our number 1. Then now we go to number 8. We say under number 8 is EFT because we paid. And it can, EFT. Then this is our cash payment journal. What did we pay for? We paid for rent expense. You can take it further and say rent expense or wages expense, but you already know that these are expenses. Then bank must decrease on the credit side because bank is an asset and assets decrease on the credit side. In this case, money went out, so bank must decrease on its decreasing side. Transaction number 9 leaves us with 2 transactions left, 10 and 11. Then after we are done with this lovely short question. And you can see in this question, it was out of 40 marks. It was fully a giveaway 40 marks. Get the entire 40 marks. Memorize all transactions that, this is common. This is how we record this. Then cuts across and master it throughout. Then we are now going to number 9. It says the owner. If it says the owner, you know that is drawings. If you say the owner, you know that is likely to be drawings, but it can be capital. Let me not say that. If you say the owner, then next one took. If the owner took, then we know this is drawings. If the owner took, then we know that is drawings. Unless we look at number 9, the owner contributed, then this is capital contribution. This is capital contribution because the owner contributed. In this case, the owner took. If it's the owner took, that is drawings. And drawings always increase on the debit side, not sometimes. Drawings always increase on the debit side. So if the owner took something on the debit side is drawings. If the owner took money on the debit side is drawings. If the owner took inventory, on the debit side is drawings. If the owner took stationery for personal use, on the debit side is drawings. If the owner took laptop from the business for personal use, on the debit side is drawings. Whatever the owner has taken will be recorded on the credit side. But the debit side is always drawings. If the owner took something from the business, you always have your drawings. And whatsoever that the owner has taken will be on the credit side. And this owner took consumables. For what purpose? For private use. That means it's completely finished to say this is drawings. And if the owner takes something for personal use, it will be drawings on the debit side, not sometimes, all the times. Then we ask ourselves, what did the owner take? The owner took consumables. Then consumables will be recorded on the credit side. If the owner took money, like for instance, the owner took money for personal use, therefore whatever the owner has taken will be on the credit side, bank. If the owner took stationery, stationery will be on the credit side. If the owner took equipment, equipment will be on the credit side. If the owner took whatever the owner that takes will be on the credit side. The first entry that is always on the debit side is your drawings. All the time, not sometimes. So now in this case, we have the owner who took consumables for private use to the value of 100 Rand. So account to be debited is drawings, as I mentioned always, and account to be credited in this case will be consumables, because the owner took consumables for personal use. Then which journal are we going to record? Did you buy something on credit? No. Did you sell something on credit? No. Did you receive cash? No. Did you pay cash? No. That means this goes to the general journal. If we sell something on credit, it goes to debtors journal, and nothing was sold here on credit. If something was sold for cash, it goes to cash receipt journal, because we would have received cash for selling something. We did not sell something here. Did we buy something on credit? No. Did we buy something for cash? No. So your cash receipt journal is not affected. Your payment, debtor journal, creditor journal. But what is affected now is what we call general journal. Then if it's the general journal that is affected and there's no money, then we have what is called journal voucher. We have what is called journal voucher. So now let us go and do our recording. Our recording is under our number 9. We said that this will be a journal voucher. It will be a journal voucher under our general journal. We said that account to be debited if the owner takes something for personal use is drawings. Then whatever the owner has taken, which in this case is consumables, will be on the credit side. So the owner in this case took consumables for personal use, then that will be on the credit side. Then we are left with two transactions, transaction number 9 and lovely transaction number 10, which is our last transaction, number 11. After now we are doing number 10. It says pay once again. If pay is pay, that means money went out of the organization. So if we pay, remember there was pay. Whenever there was pay or there was EFT, bank was recorded on the credit side. Bank was recorded on the credit side. Bank was recorded on the credit side. All the time there was a pay. Similarly, in this case, we have a pay. There is another pay. Bank was recorded on the credit side. In all this, you can look at your answer sheet if you are busy answering as I am teaching. So we paid. How much did we pay? 1,000 Rand for partial payment of the amount owing to them, which is Dodgy Dog. Let us wait about all other details. What we know is that we paid. So account to be credited will be bank. Then we ask ourselves, who did we pay? We paid Dodgy Dog. Who is Dodgy Dog? Dodgy Dog come from there, come from here. Dodgy Dog is our supplier, is our creditor, is our supplier or our creditor. The only time you'll pay a person who is your supplier later on is because you previously bought on credit. So this is our creditors control, or what you call accounts payables. So if we are paying our creditors, we are expecting them to decrease on the debit side. Let me just be consistent. Creditors control, creditors control. So our creditors control will decrease. We have paid people whom we are owing them money. So when we pay them, their account must decrease on the debit side. Creditors control or accounts payables is a liability. So whenever we pay our liability, they will decrease on the debit side. So now in this case, that is what will happen on the debit side. Then this will be now under number 10, because we paid a cash payment journal. We paid, remember, if we pay, it goes under our cash payment journal. So we know that if cash is paid, the one mistake you can make is to say EFT. If you are not sure, but there's a payment, just be sure that is EFT, or it can be what we call original receipt, because we are a customer from our supplier. So this will be original receipt. Or that means if we pay direct inside the shop of our supplier, we go to our supplier, we pay them cash, then they will give us original receipt because we are a customer. A customer always keeps the original document, and the business keeps the copy of the document, which is called duplicate. So now let us record our number 10. We said because we have paid, it will be EFT, or original receipt. Complete that one. Is a cash payment journal because we paid, remember. Then we said because we paid, bank will decrease on the credit side. Who did we pay? We paid our creditors or creditors control. In this case, we paid our creditor named Dodgy Dog. I don't know why the name is Dodgy Dog at all. I can't explain why it's Dodgy Dog. If are they really dodgy or they are not dodgy. Now, transaction number 11 is the last lovely transaction. And I'm sure now you have comprehended this topic. You have the full understanding. Hence, now the last question is a bit more of a double portion with two transactions in it. As I mentioned to you that I took it from question 2. That means you can just erase here and know that this is the continuation. I just took it from question 2. So it was number 1 of question 2 that I took, where the owner contributed 3 ceramic hair dryers to the value of 1,500 as well as 20,000 cash to the business. So that will be the transaction we are dealing with. I'm just doing this so that if you see it from the previous question paper, number 11 was not there, but I just added so that we bring the capital contribution aspect of this also under our subsidiary journal recording. Now let us then read this one from where I've pasted. It says the owner contributed 3 ceramic hair dryer to the value of 15,000 rands, not 1.5, to the value of 15,000 rands. It did not say each. Take note of that. It did not say 15,000 rand each. That means the 15,000 rands is for all of them. If we don't say each, then it's for all of them. So that means the 15,000 is for all three of them. That means each ceramic hair dryer must have a value of 5,000 rands. Otherwise, if they set to the value of 15,000 each, that means we'll need to say times by 3, because each of them has a value of 15,000. Therefore, we need to multiply by 15,000 to get the total of all three of them. But in this case, the 15,000 is for all of them. Just be mindful of such English terminology that can change everything. And but we did something like this, but because they use the word each, then it changes the whole in terms of the amount. But remember, in this case, we are not much concerned of the amount, but I'm speaking in the context where maybe you are doing a general ledger or a general journal and you need to record the correctness of the amount. So that becomes important. But money is not our main concern here. But still, it will be important in our recording. Now, in this case, just knowledge of the amounts. The owner in this case contributed hair dryer. Now we know that hair dryer is equipment. So equipment is affected. And number 2, it says as well as 20,000 cash to the business. So we can see that 20,000 of cash is bank. So bank is cash that has been received. So there are two things that are affected here. Remember, the equipment that was contributed was in the form of capital contribution. Don't forget that. The equipment was contributed as a capital contribution. Bank was contributed as a form of capital contribution. So there are two capital contributions here. We contributed equipment as capital contribution, which in here there is no bank that is affected. The value of the three equipments is not in monetary terms. It's just to say the value of this equipment is 15,000, but we did not receive money 15,000. We received equipment with the value of 15,000 rands. So for this one, for the 3 ceramic dryer, that means now we will have our equipment that will be debited because we have more equipment. Because this is capital contribution, capital will be affected on the credit side, and this will be a general journal. General journal account to be debited will be equipment. Account to be credited will be capital, and it will be our general journal. Then we'll have our journal voucher. Remember, in the general journal we have our journal voucher. Then we come to the second transaction. We say this is cash. So this will be our bank, because we received 20,000 rands. This 20,000 is received for capital contribution. So for this one is divided into 2. Capital appears twice, but equipment is there and bank is there. But for the one where there's bank, it will be cash receipt journal. It will be cash receipt journal, which then can be in the form of EFT or bank statement. So this one will be divided into 2 transactions, if I were to say so, or 4 transactions. That is our number 11, quite more requiring more thinking. We are recording the first part. We are saying in the first part, we have received the equipment from the owner. So account to be debited will be what we have received, the equipment. We have received the equipment from the owner. And this equipment is for capital that is contributed. It's capital contribution. Then there is no cash involved here. The owner gave us equipment for capital contribution. So this will be general journal. Then under a source document, it will be journal voucher. Then after we say, we also received something else from the owner, and that was in the form of cash. Remember, EFT. Then this will be cash receipt journal. What did we receive? We received money. Bank. What was this money for? It was for capital that the owner was contributing in the business. Capital contribution. So this one gets to be divided or be recorded twice. Another one will be general journal with the journal voucher. Another one will be cash receipt journal with EFT and the bank being debited and the capital being credited. And very important also to master how to record transactions that are divided into two. You must split them. Remember, very important to understand this is the fact that this transaction is capital contribution. Either we divide it into two, but at the end of the day, this is about capital that is contributed. So we know that the first part, which is 3 ceramic hair dryer to the value of 15,000, this will be increasing capital of the owner on the credit side. And at the same time, the cash that we have received will be affecting our capital on the credit side. So that means there's capital for the first equipment that was contributed, and for cash there was also capital that was affected. Hence we have two transactions: equipment that was recorded as capital contribution and bank that was recorded for capital that was contributed, recorded in two separate journals. If I was doing journal, it will be very clear to see this in one perspective. But I don't want to go there now. Let me leave you with that so far. Another popular topic in the subject called practical accounting. Normally weighs high marks also, 20, 30. In this case, it was a total of 40 marks. With those words, let me say thank you very much. I hope you got some understanding. If you have any questions, you can ask me on my channel, or else you'll see some other videos related to the modules that will pop up on this channel as at the end, related to general ledger, to your trial balance and other topics. You can please click on the pop-up link there on this channel and watch other videos related to other related topics. Your ledger account will be one of them. Thank you very much.